In this section of the course, we'll be discussing operating assets. There's three major types. We'll concentrate most of our effort on property, plant, and equipment, and intangible assets. I also wanted to mention natural resources, even though a complete understanding of these specialized types of assets are really beyond the scope of this course. Natural resources are also called wasting assets. They're basically resources of the earth that are exploited by businesses. So they are things like oil wells, gold mines, gravel pits, timberlands, those types of assets. Obviously, like machinery and buildings, these types of resources have a cost. They get used up over time, and we have to figure out the correct way to reflect their use or expense over time and the correct way to value them on a balance sheet. Many of the basic rules for natural resources are actually pretty similar to the ones for PP&E and intangible assets. Let's focus on property, plant, and equipment first. These are the major issues that we'll be discussing regarding property, plant, and equipment, and these same things will crop up again when we move our attention to intangible assets. Our first topic is acquisition cost. At what amount do we originally record these types of assets on our balance sheet? In general, we record them at the amount we gave up to acquire the asset, which we call historical cost. More specifically, we need to include all of the normal and reasonable expenditures that we incurred to get that asset up and ready to use for the first time. So, for example, if a company buys a piece of equipment, the acquisition cost of that equipment and the amount at which it will be initially recorded on the balance sheet includes the invoice price, generally net of any discounts for early payment on account, so the net purchase price plus things like sales tax, cost of getting the item shipped to your place of business, installation costs, and a host of other expenditures, anything that would have been reasonably necessary to get that asset ready to use. Next, let's consider a purchase of land. The acquisition cost of land would include these types of costs: realtors' commissions, attorney's fees, and all of these other things. In fact, if there was an old building on the land and you bought the land so that you could tear the building down and build a new one, the cost of the land would include the cost of removing that old building, because that was necessary in order to get the land ready for its intended use. Let's consider a slightly more complicated situation where a company is actually self-constructing an asset. So, for example, a company bought some land and now it's constructing a building on that land. Obviously, the costs of all of the incremental labor that goes into constructing that building and the cost of all the materials that goes into constructing that building need to be capitalized as part of the cost of the asset. Where it gets a little bit more interesting is when you're talking about types of overhead costs that would be considered fixed overhead costs. So, for example, consider a company who is self-constructing a building and they put one of their managers in charge of the building process, and the manager's paid $100,000 a year. Let's assume that the manager spends about 15% of his or her time on the construction project should $15,000, 15% of the $100,000 salary, be treated as part of the cost of the building or not? The full cost approach would say sure, add that $15,000 to the cost of the building because that manager spent that much time on the building project. The incremental approach would say, yeah, but you would have paid that manager $100,000 regardless of whether he or she was involved in the construction project. It didn't cost you anything additional to put that person in charge, so you should not add anything to the cost of the building. Both approaches are currently in use. The second interesting issue as far as accounting goes is what's the proper way to treat interest expense that's incurred during the construction period. The rule is that when an asset is constructed for a company's own use, we capitalize or add to the cost of the building what we compute to be construction period interest. Construction period interest is the amount of interest that could have been avoided if you weren't doing the construction project. So even if a company doesn't borrow any money for the construction project, if they have other debt outstanding while they're doing a construction project, the idea would be if you hadn't spent the money on that building, you could have paid off the other debt, so you have some avoidable interest. So you could have construction period interest even if you hadn't borrowed a dime for your actual construction project. So construction period interest is that interest that could have been avoided if you hadn't done the construction project. When we compute construction period interest, we start capitalizing interest when all three of these things have happened. The construction has begun, there's interest being incurred, and you've actually got some qualifying expenses being incurred. The construction period ends and you stop capitalizing interest when the asset is ready for use or when you've stopped incurring interest. The computation of construction period interest is again beyond the specifics of this course, but I would like you to know that when there is construction period interest, it's capitalized. In other words, it becomes part of the cost of the building. If a company incurred $200,000 of interest during the year and $50,000 of it was deemed to be construction period interest, $150,000 of interest would be interest expense, and the other $50,000 would instead have been capitalized as part of the cost of the building. Now let's talk about one final acquisition cost issue for accounting, and that's when you have a basket purchase. A basket purchase occurs when you buy many different types of assets together, and it's a really common type of situation. So for example, a business might pay $1 million for a motel. Well, what are they actually getting when they buy that motel? They're getting lots of different types of assets. They're probably getting some land and a building. It's probable that inside that motel is some furniture, and there's probably some miscellaneous supplies that come along for the deal as well. Well, how would we allocate this $1 million cost among these various types of assets? Before we do that, let's talk about why we would even bother. We would need to allocate this $1 million to the various categories of assets because they have different treatments for accounting purposes. Land is not depreciated because, in general, it has an indefinite or extremely long life. Buildings and furniture get depreciated over time, but they have different useful lives, so we need separate categories for assets with different useful lives. And supplies are generally inventoried, counted, and expensed as they're used up. So we need to allocate the correct or our best estimate of the correct amount of this $1 million to each category so that we get correct future treatment. How would we do it? Well, we would need to determine the relative fair market value of those categories of assets that we purchased. So you would have, most likely, if you couldn't do this yourself, you'd hire an appraiser who would come in and say, okay, let me tell you independently the fair value of each of these assets if you had bought them on your own. So in this case, an appraiser has given us separate fair market values for each different type of asset. In total, if we had bought each of those assets separately, we would have paid $1,200,000 for it. And that's oftentimes the case. When you have a basket purchase, you're generally paying a bargain price because you're buying everything together. We can use these separate fair market values to help us allocate the cost. For example, the fair value of the land was $300,000. Out of the possible total, $1,200,000. So, since the land represents 25% of the value, we will allocate 25% of the cost to the land. So 25% of $1 million, $250,000 of the cost will be allocated to the land. Similarly, building's 50% of the value, it should also be 50% of the cost, and so on down the line. This is the normal way in which companies allocate a purchase price when they buy multiple assets.